Ever feel like you're working hard but your money isn't? Like it's just sitting in your bank account, barely earning any interest while prices for everything just keep going up? Now, I know what you might be thinking. Investing? That sounds complicated, risky, and isn't that just for people with loads of money and fancy suits? I used to think the exact same thing, but the truth is, investing is one of the most powerful tools you have to build real, long-term wealth. It's about turning your small, consistent savings into a significant nest egg that can help you achieve your biggest life goals, whether that's buying a house, traveling the world, or just having the financial freedom to live life on your own terms. No jargon, no complicated charts. Just a simple, straightforward guide to get you started on your investing journey, even if you're starting with just a few pounds. You'll often hear three terms thrown around: stocks, funds, and ETFs. If the company does well and grows, the value of your stock goes up. If you pick the right company at the right time, your investment could grow significantly. However, this is also where the risk comes in. This brings us to our second option: funds. Imagine a big basket where a professional fund manager collects money from thousands of investors like you and me. They then use this massive pool of money to buy a wide variety of investments, maybe 50, 100, or even more different stocks, bonds, or other assets. This is a mutual fund. Now for our third option, ETFs, which stands for exchange-traded funds. The main difference is how they're traded. Unlike mutual funds, which are priced once a day, ETFs can be bought. This means they simply track a market index, like the S&P 500, instead of paying a manager to actively pick stocks. For beginners, the combination of instant diversification, low cost, and simplicity makes ETFs an incredibly popular and powerful choice. So, we've talked about what you can invest in, but what about the big scary R word? Risk. It's the number one thing that holds people back. The fear of losing money is real, but risk isn't something to be afraid of. It's something to be understood and managed. Let me explain it simply. In the investing world, risk and reward are two sides of the same coin. Generally, investments with the potential for higher returns also come with higher risk. Investments with lower risk usually offer lower potential returns. Think of it like a ladder. At the bottom, you have things like cash in a savings account. It's super safe, the risk of losing it is almost zero, but your potential reward is also tiny, often less than inflation, meaning your money is actually losing purchasing power over time. As you climb the ladder, you get to bonds. These are essentially loans you give to a government or a company. They're safer than stocks, but offer more growth potential than cash. At the top of the ladder, you have individual stocks. They have the highest potential for growth, but also the highest risk of loss. Funds and ETFs sit somewhere in the middle. They spread the risk out, making them less volatile than single stocks, but with much more growth potential than cash or bonds. The key takeaway is this: investing isn't about avoiding risk altogether. It's about choosing a level of risk you're comfortable with and that aligns with your goals. The single best way to manage risk is through diversification, not putting all your eggs in one basket, and by investing for the long term. The stock market goes up and down in the short term, that's a guarantee. But historically, over long periods, it has always trended upwards. Time is your best friend in managing risk. Okay, theory is great, but let's get practical. You're a beginner, you have some money saved up, and you're ready to make your first move. What should you actually invest in first? My recommendation for the vast majority of beginners is simple. Start with a low-cost, broadly diversified index fund, or ETF. Let's break that down. Broadly diversified means it invests in a huge range of companies, not just one sector or country. Low cost is crucial because fees are a silent killer of your returns. And an index fund, or ETF, is one that simply aims to mirror the performance of a major market index, like the FTSE 100 in the UK or the S&P 500 in the US. You don't need to spend hours researching individual companies. You are essentially betting on the entire market to grow over time, which, historically, has been a very good bet. Second, It's diversified straight out of the box. Because these funds are passively managed, their fees are rock bottom. A great example of this is a global index tracker fund. This type of fund invests in thousands of companies all across the world, from the US to Europe to Asia. You're not just betting on one country's economy, you're betting on global capitalism and human innovation as a whole. It's the ultimate set-it-and-forget-it strategy for beginners. You can find these funds on almost any major investing platform. Your first step is to open an account, find a global or S&P 500 index tracker ETF, and make your first investment. It's truly that straightforward. Now for the most important part, how to actually do it. It's easy to feel overwhelmed, thinking you need a huge lump sum to get started. You don't. The secret to building wealth isn't about timing the market. It's about time in the market. It's about consistency. So let's create a realistic plan that anyone can follow, whether you have £10 a month or £100 a month to spare. The strategy is called dollar cost averaging, or pound cost averaging here in the UK. All it means is investing a fixed amount of money on a regular schedule, say every month, regardless of what the market is doing. Let us say you decide to invest £50 a month into that global index tracker ETF we talked about. When the market is high, your £50 buys you fewer shares. When the market dips, your £50 automatically buys you more shares at a discount. Over time, this averages out your purchase price and smooths out the bumps of market volatility. It takes all the emotion and guesswork out of investing. You're not trying to be a genius and predict the market's next move. You're just being consistent. Imagine you start with just £100 and add £100 every single month. Assuming a historically average annual return of about 8% from the stock market, after 10 years, you would have invested £12,100. After 20 years, you would have invested £2,400, but your account could be worth over £58,000. You would have invested £30,601, but it could have grown to a massive £148,000. That's the magic of compound interest. Your money earning money, and then that money earning even more money. The numbers speak for themselves. You don't need to be rich to start. You just need to start. Open that investment account. Set up a direct debit for £10, £50, £100, whatever you can realistically afford. Then, let time and consistency do the heavy lifting for you. And your journey to financial freedom begins with your first investment, no matter how small. Thanks for watching, and if you found this helpful, please give it a like and subscribe for more simple guides to help you grow your wealth.